Walmart delivered a mixed quarter. It topped expectations on revenue and it is raising its sales forecast. However, tariff-related costs continue to rise. In May, US President Donald Trump told the company to, quote, eat the tariffs. But can Walmart just absorb these levies? Our guest says the stock, it's under a bit of pressure today, can outperform. We're joined by Zhihan Ma, Senior Research Analyst in Retail at Bernstein. Thanks very much indeed for joining us. Just to get the latest quarter out of the way, it appears there were one-off insurance costs and legal expenses that damaged profit.
Yeah, absolutely. I think you put it exactly right. It's been a mixed quarter, right? Walmart had top line exceeding expectations, but on the EBIT line, I think a lot of the miss was, to your point, the one-time insurance liability accrual they have to take, which is also reflecting the higher inflationary expectation and environment we're in today. So if you take that out, they would have actually beat bottom line EBIT and EPS expectations. And then you look at their full year guidance, right? So they raised on the top line, they raised on EPS. The EBIT guidance was maintained despite the higher general liability costs they had to incur both in Q1 and Q2, so basically the first half of this year, which implies that if you were to remove some of those one-off factors and the general liability cost, Walmart's EBIT guidance is actually not far off from what they were able to deliver in the previous years. But of course, this year's numbers really being weighed on by a number of one-offs.
The stock is still down from February. Maybe we'll put up a 5-year chart. Why is that? Why have investors not been grabbing Walmart? I mean, here in Canada, for example, a discount retailer like Dollarama has been hitting record highs.
Yeah, absolutely. I still very much like the longer term 3 to 5 year story in Walmart. I would say the stock is kind of priced for perfection in a certain sense, right? It rallied 70% last year. So coming into this year, the expectation, the bar is a lot higher in terms of what they have to deliver. That's on the top of, over the past 2 years, Walmart delivered 5% top line growth and 10% EBIT growth. So coming into this year, the drop you saw in the February timeframe was when they reported Q4 earnings, and they guided to a below expectation fiscal 26, calendar 25, where they guided to a below 10% or below high single digit EBIT growth. As I mentioned, some of that is weighed by the one-off factors, but clearly the tariff uncertainties, the cost being higher, is also impacting Walmart's ability to deliver another record profitability growth year this year.
Talk to us a bit about the international operations of Walmart. For example, it looks like a big jump. Same-store sales up more than 10% on a constant currency basis. For China was a growth story for them, for example.
Yeah, so international is a very exciting portfolio for Walmart. I would say if you look at China and India, those two markets are really showcasing what the future of omni-channel retail looks like, right? They are doing more than 50% of their sales in China, mostly through the Sam's Club format, which is resonating really well with local consumers. They're delivering 80% of those orders within an hour to underlying Chinese consumers, and they're able to be profitable in that business without kind of the high margin retail media alternative revenue streams, which is really impressive. India, similarly, they have the Flipkart business, they have the PhonePe business, and they're entering into quick commerce to deliver products within as quickly as 15 minutes, or in some cases, a few minutes to underlying consumers.
15 minutes! Talk about instant gratification. Yeah, that's interesting. I mean, China obviously has sophisticated e-commerce players, but Walmart is holding up against them, or at least it is competitive.
I think it's a somewhat of a unique concept, right? The Sam's Club format, there's a timing element of it too. I think they were well positioned to capitalize on COVID, right? When people were social distancing and stocking up on big bulky products during COVID. And that's when Chinese consumers really discovered the Warehouse Club format. Okay. It just happens that Walmart were already investing into Warehouse Club, into their e-commerce delivery. So they were really well positioned to capitalize on the upward trajectory. And since then, it's been a really rapid growth. And Chinese consumers seem to be really loving the Warehouse Club format. It's one of the few brick and mortar formats that's actually growing on the ground.
I'm sorry, I just want to clarify, just looking at Walmart stock, you do see upside. Is it expensive? Can you just clarify for me?
It's expensive. We do still see upside. It does require you to have a bit of a longer time horizon, right? So is there going to be another 20, 30% upside this year? I don't know. I mean, I think this year is largely behind us at this point, right? The guidance is looking like it's not the most outrageous growth year for Walmart per se. But if you have a 3 to 5 year time horizon, still very much like the upside from here, right? It's very much an e-commerce driven profitability improvement story from here. And I think the reason why it looks expensive on paper is because the sell side estimates, and myself included, we're not completely baking in the mature stage earnings power for Walmart over the next 12 months. And over the next 3 to 5 years, you're going to see that playing out, and Walmart is going to look much less expensive when they reach the mature stage. But for now, PE multiple looks artificially inflated in my mind.
Zhihan, thank you very much for joining us.
Thank you.
Zhihan Ma, a senior research analyst in retail at Bernstein.